Good morning, ladies and gentlemen. Welcome to the RBG Holdings PLC Results Investor Presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged, can be submitted at any time just using the Q&A tab situated on the right-hand corner of your screen. Please simply type in your questions at any time and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and will publish those responses where it's appropriate to do so. Before we begin, we'd like to submit the following poll, and I'm sure the company will be most grateful for your participation. I'd now like to hand over to the management team. John, Kevin, good morning.
Good morning. Good morning, everybody. Thank you very much, Mark. Very warm welcome to our results presentation for the unaudited accounts for period ending 30th of June 2024. My name's John Divers. I'm the CEO. Sitting alongside me this morning is the Chief Financial Officer, Kevin McNair. This is a slightly abridged presentation. We don't normally do one of these mid-year. But it's fair to say there's been an awful lot going on within our business, and we felt it was only fair and proper that we have a platform in which we can take you through and try and explain a little bit more behind the numbers. So there are obviously established investors, potentially some new investors on the call this morning. So very, very quickly, who are we? We are now an exclusively legal-focused professional services business listed on the AIM market. Historical presentations in this forum had other additional and different professional services, and the final one of those the final one of those was called Convex Capital, and we divested the business of that in April of 2024. In terms of an executive summary, we've stated many times in forums such as this or in individuals meetings with various investors that we very much wanted to return the group's focus to its fundamental, its core legal services background. We have two established London law brands, namely Rosenblatt and Memory Crystal, both with over 30 years of proven track record. And we have spent the last 6 months, we spent last year, and we'll continue to spend our time very much focusing on driving that core revenue generation from within the legal services sector. We'll look for incremental, we'll look for accretive growth that complements the law sectors that we currently have, and continue to try and expand our offering as a full service legal provider. In terms of that, just some numbers: we've hired 9 new partners. I say hired, I think the 9th one of those starts with us this week. And we've also promoted 4 internally during the 12 months that have just passed. So 12 months to June 2024. The group had risks that we felt we needed to try and reduce. And the final piece of that was, as I say, the selling of Convex Capital in April of this year. Convex was, for people who don't know, a boutique M&A advisory business based out of Manchester. It was a very binary business. The fees were contingent, and therefore potentially there was an opportunity for very skilled and very good people to work very diligently for a long period of time. And then if the deal fell over at the 11th or even the 12th hour, ultimately there would be no reward. So in sort of buoyant M&A environments, it was very, very good. In a slightly more depressed or suppressed M&A market, it became far more of a challenge. Investors didn't particularly like it. We would always caveat any numbers we put out with the fact that if Convex delivered on such and such, then we would do the other. And therefore the decision was made probably in late 2023 to look for potential suitors, and eventually the management led a buyout, and we wish them well as they go on their own. Obviously, there are a few legacy balance sheet issues that we cleared up once Convex had been sold. And really, probably the big thing, and I'll come onto this and expand in a few slides' time, is accelerating the reduction of the group's cost base. We've been striving to do this certainly for the last 6 or 9 months, and we feel we've had some pretty big successes as well. It was root and branch. It wasn't just the big stuff that's pretty obvious. It was absolutely at every single level. So in terms of the business overview, just a little bit more fleshing out who we are. We are, as I say, 2 very well established London law brands, Memory Crystal and Rosenblatt. we operate from one effective legal entity, one SRA license, which is within RBG Legal Services Limited. RBG Legal Services is purely an internal brand. We don't market that externally. As I say, it holds the employment contracts, it holds some of the leases and the rents, etc., and it allows us to trade from two distinct brands. First of those, Memory Crystal, started in 1978. Predominantly and rather crudely, we split it into real estate and corporate, so very much transactional work, but within there are far more additional areas. So within corporate, for example, we would have banking, we would have copyright or IP work, we'd have employment, we'd have tax. Same as in real estate, we have both commercial real estate, we have real estate construction, we have real estate litigation. So, excuse me, in terms of the transactional work that we do, a very broad offering. And then secondly, we have Rosenblatt, which is our contentious or our disputes area of the business, established in 1989 by Ian Rosenblatt, who's still very much within our business. It's generally high value, complex cases, and they say, how do you sort of judge yourself in terms of where you sit in a legal hierarchy? Generally, we judge ourselves particularly on who's on the other side. And a lot of the time, Rosenblatt's opposing lawyers are sort of silver circle or magic circle kind of firms. Very pleased that Memory Crystal was ranked in 12 categories in the Legal 500 in 2024, and Rosenblatt was ranked tier 1 in Legal 500 for commercial litigation for mid-market. In terms of the numbers, and this is not necessarily a slide that shows numbers where we'd like it to be. I think the bottom right and the bottom middle really highlight the challenge that we've had, which is mainly around revenue. We're 61% utilised. That number should be above 70, and we're 66%, beg your pardon, in terms of our realisation or our recovery. And ultimately, that sort of highlights the fact that we haven't been busy enough. January through April was pretty good, was kind of where we would expect it to be. And then very much from May and June, it was marked how fast revenues fell away with the announcing of the general election. It's led to 18.4 million in revenue against a budget of around just over 21 million. Operating profit, group adjusted EBITDA of pretty much flat line at 30,000 and a small 0.2% adjusted EBITDA margin. In terms of what's good, we have been focusing on our cash collection. We have been focusing on our lockup. Again, for those who aren't familiar with the professional services world, lockup is from the date from when you commence work to when you get paid. So it's a combination of the WIP days and the debtor days. And for example, our debtor days, a focus on cash collection has meant debtor days within that 126 has come down from 58 to 49 days. So hopefully we're realising and seeing the cash a little bit sooner. In short, our costs within the business are pretty much where we would expect them to be, even with some exceptional one-off items. They're largely in line. The challenge, as I say, has been fundamentally a lack of revenue. Where does that revenue come from? Just a split of within the firm. So as I say, disputes, the lion's share there at 41%. So think about the old Rosenblatt brand that I just mentioned to you. And then Memory Crystal taking in the corporate and the real estate work. And again, just to give people a little bit more colour, within corporate showing there at 6.9 million. Of that, banking made up 1.9 million. As I say, CIPT, so IP work, copyright, etc., made up 1.1 million, and employment made up about 500,000. Within real estate at 3.9 million there, you've got real estate litigation, which contributes 1.4 million, and real estate itself, so the more commercial real estate work we see, especially here in London, of 2.2 million. So what have we been focusing? Cost. Towards the back end of 2023, we were exploring this further. We made no bones about the fact that it was starting to sort of tail off. We could see the revenue begin to drop off a little bit in October 23. As I say, that was slightly arrested, should I say, throughout particularly the first quarter and into April, despite the fact that depending on when Easter falls, you can quite often have a very strong March and a weaker April, or vice versa. The big one of those costs is largely property, and it's taken a very long time to finally exit an old legacy building here in London in St Andrew Street. We had, I beg your pardon, two buildings, which are legacy hangovers from two different law firms, one of whom ultimately acquired the other, and the coming together of those here in Fleet Street. So we effectively had an empty building. Yes, we had to pay a surrender premium to get out of that. But in the round, that will save us £4.5 million over the next 3 years in rent and rates and service charges after having paid the penalty to get out. We're also, I'm delighted to say, we have a heads of terms and are moving forward to reduce our footprint further here in Fleet Street. We had a business that was effectively paying somewhere in the region of £5 million a year in rent and rates and service charges and electricity, etc., etc. And where we'll be is a business that's probably paying between 1.5 and 1.7 million in those. So a huge saving. The numbers that we crunched when we look forward to 3 years, which 3 years being relevant because that's when the break clauses were in the two leases that we had, we're going to save between £7 and £8 million. The reason I say between, and I don't exactly know, is because we're not entirely sure where our rateable value will come in, but it's certainly going to be north of £7 million. So huge savings there. This is a people business. It's a professional services business, but despite that, we did make an extremely difficult decision when you look back at the utilisation and the realisation numbers, that potentially we had too many people or not enough work. As the work didn't come in, or rather didn't grow, and then potentially fell away, we did make the difficult decision that we had to lose some people. We managed to do that as best we could through attritional levers, non-replacements, etc., etc. But unfortunately, a few people were made redundant. And then again, across all contracts, what we're still experiencing, seeing, is sort of old legacy historic contracts from two different businesses that have sort of been cobbled together. And as they naturally mature, we can see some of the benefits of those cost savings. To give you an example, in terms of servers, where we host all of our external data within the cloud, once we sort of exit some old legacy server contracts in probably October, November, we're going to be saving around £180,000 a year. So it's that, but it's also, for those of you who are interested in your sport, people talk about marginal gains and the aggregation of marginal gains. And what I'm sort of trying to convey here is we don't just look at something and say, oh, it's only a £500 saving, or it's only a £1,000 saving. We have a bit of a project team that looks at every single one of those across all areas. And if we can save £500 on coffee machines, or £1,000 on our cleaning, that's what we've been doing. And we would expect to see these results really sort of filter through and give us some benefits as we look into 2025. Right, I'm going to be quiet for a little bit now, and I'm going to hand over to Kevin, who's going to take you through the financial performance.
Morning, everybody. So comparative figures, first 6 months of 2024 versus the previous year. We're at 18.4 million of revenue this year versus 19.8 last year. That's clearly a drop. Last year was a bit flattered because we had the tail end of a very large project from 2022, which pushed up the figures quite significantly in January. But ultimately, the 18.4 is about 3 million off of budget, where we want to be with the business in the first half of this year. That means that on an adjusted EBITDA business, we did slightly better than breaking even. And as John mentioned, that's a margin of 0.2%. This is a business that should be producing EBITDA margins in the low to mid 20s, and that's where we need to get the business to as quickly as we can. We also incurred non-recurring costs of 2.9 million, slightly less than last year, and that goes back to some of the historic things that we've talked about in previous presentations, and some restatements from previous years. We'll get into the detail of that in a minute. The net debt at 24.3 million is obviously higher than we wanted it to be. It was 21 million last year, same point last year, but subsequent to that, HSBC advanced us another 2.5 million, and you've actually got accrued interest on that. Next slide, please. So the non-recurring costs, the non-underlying costs that don't have to do with what the business is going to take forward with it. The big issues are you've got remuneration paid in respect of prior periods. So historically what has happened is the business would finish a fiscal year and then look at people's performance, and bonuses were paid or commissions were paid based on previous performance, but those had not been accrued in the period for which they apply. So we decided this year we're actually going to start accruing these commissions and the bonuses in relation to this year in advance. So this year we've effectively, from an accounting perspective, we've got the 2023 commissions and an accrual for the 2024. So we've stripped out the remuneration that relates to the previous year, so you can see what is actually happening in 2024. There's a trade receivable provision against one of the last damage-based agreements that we had. And that's where we've effectively paid some disbursements on behalf of the client. Should we lose, they would have to pay us back, but we actually have taken a provision because we're concerned about their ability to pay us back should it come to that. You've also got $650,000 of restructuring costs, and that relates to the redundancy program that John mentioned earlier. That was effectively the cost of us taking out the people from the business that we viewed were just not busy enough. So those are the other things. There's a sort of one-off category of other one-off costs. Again, a lot of that relates to us cleaning up things from prior periods in terms of onerous contracts and things like that. Next slide, please. In terms of the balance sheet, if you compare it to this time last year, we're basically 28,000 lighter in terms of net assets. The vast majority of that has to do with the write-off of intangibles, either because of the loss on sale of Lionfish last year, which happened in July, or the loss on the disposal of Convex this year, and then you've got the accumulated losses. The remaining goodwill is in relation to our existing business, Rosenblatt Memory Crystal, and we view that as having future value. That's it for me, John.
Okay, thanks, Kevin. So what are the management really going to be focused on? Well, it's largely unchanged. We want to continue to grow our revenue. We've often stated that we would look to grow that organically. Fundamentally, the right-hand one of those three, the reduction of the debt, can't happen until the business is back in profitability. You heard me a few slides ago talk about the enormous cost savings that we've been able to realise. And actually, looking ahead, we can see how that will impact on our fundamental bottom line into 2025. But ultimately, the return to profit and the reduction of debt remain our key areas of focus.
John, just one comment, because I'm sure we'll get some questions on this. In terms of the debt, we've remained within our covenants and expect to remain within our covenants in terms of that facility. Just to remind people, it was extended last December until the 31st of December 2025. And HSBC remains a supportive stakeholder in the business. Okay.
Thank you. So how do we grow revenue? Well, as I spoke about a couple of slides ago, we unfortunately did look at headcount reduction through a redundancy process and not replacing attritional people who'd left. In amongst that, we were still looking. There's no headcount freeze here. We were still looking for and to recruit partners who bring additional revenue. And I said in one of my first slides about the sort of additional accretive and complementary areas of the law. And we've had some great success this year, particularly around international arbitration. We've added in terms of insolvency practice. We've got a couple more corporate partners. Some of the partners who are coming through who've been promoted sit in certain areas of real estate or within corporate. So exciting times, and some of those partners who've turned up hit the ground running. Some take a little bit a little bit longer to get up to speed. Underlying all of that, and this is really for those of you who've watched me and previous management present, we spoke about a thing called Peppermint. We spoke about a thing called a single practice management system. That's still only just a little over a year in terms of being embedded in our two legal brands. So up until sort of last May or June, it was very, very difficult to see what the other side were doing. And ideally, if we're doing corporate work for a large corporate client, we would like to be able to pitch for their dispute work or their real estate work, and any combination of the three. And we've seen some great successes where we have shown that we're a law service provider who can do very large, very complex transactions. So, and the final piece that we would like to do, and we sort of crave really, is some form of annuity income. And I can't say too much about this, but the world of AI is throwing up a lot of interesting opportunities around being able to effectively have a legal product that we can sell, and obviously then has a sort of monthly or an annual retainer, which would add revenue. So I suppose on that one, all I'd say is maybe watch this space. As I said, those cost savings are not really going to filter through until the first half of 2025. The new partners, we like to see them, grow and bring in those revenue streams. It is interesting to see how sort of quickly the city and the economic markets sort of come out of their what can only be described as a 18-month or so slump. And we do definitely see far more activity. The pipeline is certainly stronger than it was maybe sort of 6 or 9 months ago. However, the pain that we've gone through in those past 6 or 9 months does very much leave us with sort of more streamlined departments, and I think they're very much ready now to kind of kick on, and we'll see those utilization numbers pick up. We are doing already. We look at how sort of September would compare with June. They're wildly different in terms of their performance. And obviously what that hopefully would do is allow us to actually generate some cash and start to see a reduction of the debt. 2024 didn't support that. There wasn't the free cash available. And those one-offs and sort of slower trading, particularly in Q2, did affect cash generation. As Kevin already said, we have a supportive lender and a facility that doesn't expire until 2025. But to be honest, we'd like to be out on the front foot. We'd like to be talking about what we've just shared with yourselves online today to potential funders in the future, and we're already kind of exploring those options and what that might look like. So that's a fairly brief overview in terms of where the business has been for the last 6 months. I think there are a few questions, but from our presentation side, that's it. So just briefly back to Mark.
That's great. Thank you to you both. Ladies and gentlemen, please do continue to submit your questions just using the Q&A tab on the right-hand corner of the screen. But just while John and Kevin take a few moments to review your questions submitted already, I'd just like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, will be accessible via your Investor Meet Company dashboard. John, Kevin, you've had a number of questions from investors throughout today's presentation, and some we received ahead of, so thank you to everybody for engagement. If I may, John, just hand back to you just to take us through that Q&A, and I'll pick up from you at the end.
Absolutely. Thanks, Mark. Do you want to do the first one?
Yeah.
So the first one, how much debt have we been able to repay in 2024 so far, and what's the current debt level?
Yeah. So as we showed in the demonstration, in the presentation, we've not really been able to reduce the debt this year for the reasons that John set out, and we don't expect to reduce it materially over the rest of this year. And when I say materially, we were targeting originally getting down to 22 million or below. I don't think we're going to be able to reach or beat that target. It depends on cash generation over the last quarter. Shall I pick up on that?
Yeah, do you want to do the next
one? In terms of the key matrices that we use, fees per full-time employee, they if we look at those and compare them first 6 months of last year to first 6 months of this year, they will have not improved, they will have gone backwards. And that has to do with the fact that we had, for most of the first half, we had a similar number of employees to last year, but we had slightly less revenue. If we actually ran those matrices with the number of people that we have now, post the restructuring that John mentioned, they would improve. And we'll look at perhaps doing something in the full year presentation. Utilization, again, it showed 61%. That should be in excess of 70% across the business. And that's what we're targeting for H2. In terms of revenue growth, again, it goes back to what John said about that's going to come through us acquiring new partners and some of our key markets picking up from where they've been over the past 12 to 18 months.
On to the next one. How many clients account for 80% of the revenue? It's actually our client base has become more diverse over the last 18 months. And obviously this changes. It's a very difficult metric to answer because it changes. It would change almost every single month. I suppose what I could say is no client accounts for more than 10% of our annual revenue. And the pleasing thing, as I say, is the fact that the pool, the client base has got significantly wider over the past sort of 2 years or so. Do you want to pick that one up? You're very close.
Yeah.
Sorry, the questions. You're very close to the bank credit limit. How confident are you that this will be sufficient? And if additional short-time liquidity is needed, what is the plan?
Yeah. So as I mentioned earlier, the relationship with HSBC is actually very strong. They've been very supportive. They understand that it takes a while to turn these businesses around. So we're comfortable and confident with that. Our forecasts show that we remain liquid. So again, not necessarily concerned about that right now. It sort of ties into the next question.
Why are we hiring? That one.
Sorry. Yeah.
Sorry, that one.
Yeah.
The debt position of the company looks unsustainable. Are you considering an equity raise in order to normalize the capital structure?
Yeah. Not at this point, I would say. We obviously did a small equity raise back at the beginning of this year, and that helped us through quite a tight period. We obviously are very conscious of dilution and looking after shareholders' positions. So we're not at this point looking at any equity raise in the foreseeable future.
I'll pick this one up. Why are you hiring when utilization is lower than expected and cash in the business is very tight? Because the people that we've been hiring are intended to bring revenue with them. We've largely been hiring partners. Utilization is across all fee earners, but poor utilization is an indication that we have too many people lined up to do the work and fundamentally not enough work. And in any organization such as ours, you have people who are, revenue generators, and then those who actually process that work, and any sort of variation in between. So to answer the question, because the hires that we've been making, the people who left rather, and it wasn't just fee earners who left, it was operational staff who left. It was sort of accounts or reception or those kinds of roles as well as fee earners. But the people that we're recruiting are all intended to add and be accretive in terms of the revenue. Will there be cuts to payment? Will there be cuts to payments to existing staff as a result of the exceptionally poor performance? Emotive, most certainly, and probably not. We are a publicly listed company. We are a limited company. And therefore we're governed by UK employment law, and people have their contracts. If it gets to the point where we potentially have to look at reduction of our wage bill, we would have to negotiate and consult with our employees. We're not a sort of old traditional law firm whereby we can just reduce people's salaries.
But it's worth pointing out. A significant portion of partners' remuneration is based on their performance. And so obviously, if they're not performing, they will not get those incentive payments. So there is a mechanism for us to reduce our costs if people are not bringing in the business that they should.
What proportion of staff are on performance-linked rewards? I would say almost all. Certainly all fee earners. We are a meritocracy. So people can earn more if they bring in the work, do the work, work hard and generate both revenue and profits. In terms of the operational staff, again, any bonuses or would be linked to performance. Okay, it's quite a long question, so bear with me. This is another real blow to shareholders. John sounded relatively positive about the future since a TU in July 23.
Trading
update. And already suffering share price has gone from 25p to 3.5p today. Are we finally seeing the light at the end of the tunnel? And given how profitable the business appeared to be previously, why is this such a difficult and lengthy process? Please also speak about the commitment to remaining listed. That last piece, so absolutely, we are committed to remaining listed. And actually, one of the benefits of being listed, you could see in the past 9 months when we were able to do an equity fundraise with the support of our shareholders. Yes, I would like to think this is light at the end of the tunnel, largely because of cost. Our cost, I still think we can trim our cost a little bit more, primarily sort of that property piece, the second one, and the fact that we'll be moving from 3 floors here in Fleet Street to sort of 1.5 floors. It reflects post-pandemic, more agile, hot desk type of working environment. And actually, it's what we need to be doing and should be doing. And we're grateful to our landlords who have largely sort of allowed us to exit for sort of market sensible covenants and payments. But we cannot stress enough the cost. I mean, the cost that's come out of the business in the past sort of 6 or 9 months will be north of £4 million, so almost 10% of our revenue. And ultimately, it's not fun for any of us to be sitting here telling our shareholders that things have not gone particularly well. But we do actually look forward with a certain element of optimism and believe that from here we can hopefully kick on into 2025 and start to return to profit.
And just picking up on the point about the length of this, an old boss of mine a long time ago said any turnaround is going to take a minimum of 18 to 24 months, and we're roughly 18 months into this, and we can see how things are improving. So as John said, yep, there appears to be a growing light at the end of the tunnel.
Okay, have any of the management or leadership team sold their shares in the last few weeks or months? No. One, we've been in a closed period for a month now, yes. Which means we're not allowed to. But secondly, none of us have a desire to. And actually, in terms of the directors, the exec directors and the chair actually invested in the fundraise earlier in the spring. So no, we have not been.
And for the avoidance of doubt, should anyone on the board choose to sell any shares, we would have to announce that to the market. So it's a very obvious thing when that happens.
I think this is the final question. Why would you take on business where fees are contingent on a client completing on a deal? Did the lawyers get paid on the basis of heads, they win bonuses, and tails, shareholders pay their salaries? No. So we take on business from any number of different places, and fee structures vary depending on the type of deal it is. I think what someone's alluding to there is probably the more corporate work, which is where maybe we're trying to do a fundraise or a listing, and obviously a lot of the time those deals can get paid at the end out of the proceeds of the fundraise. What we've been doing over the past couple of years is getting a bit more of a tighter grip on that, because you're right, it's effectively gambling, and if it falls away, you don't get paid. So we're far more insistent now on money on account or payment. A lot of these deals have what's called an abort fee. So if a deal has a quota of maybe £150,000, the abort fee might be 70 or 80. And therefore we'd look to get that 70 or 80 on account or paid within the first sort of month or 6 weeks. That's something that wasn't happening historically, and it's one of the reasons why some of the the legacy bad debts look quite high. Approximately, hey, do you want to say this? How long do you feel the company will take to get to the 20% plus EBITDA margins mentioned by Kevin?
I think that is a target for 2025. I think it's a realistic target if markets pick up. We don't need things to start roaring, but we actually need them back to more normalized levels. And I think that's what we should be targeting ourselves on for next year.
Although still looking into the future, will you aim to become debt-free? Yes, we'd love to become debt-free, and it's certainly our aim. Obviously, we're going to have to generate more revenue and more profit to be able to pay down that debt. Obviously, again, referring to one of the earlier questions, somebody mentioned about our commitment to staying on AIM, and there's always a possibility in the future around some kind of equity. Not saying that's planned. We don't want to dilute shareholders to ridiculous degrees. But yes, our commitment is, and our aim is that we would firstly reduce debt and then ultimately clear it. And I think that's it.
That's great, John, Kevin, thank you very much indeed. And of course, if any other questions are available, we'll make those available to you post today's call. Kevin, John, I know that investor feedback will be particularly important to you both. I'll shortly redirect to investors on the call to give you their thoughts and expectations. But maybe, John, before doing so, I could just ask you for a couple of closing comments.
Thank you very much, Mark. Thank you for coming on this morning. Thank you for listening, and thank you for your constructive questions. It's been a difficult 6 months. Hopefully the cost cutting that we're doing gives you confidence that we're trying to reposition and set the business up for the environment that it operates in today. We believe the board, the wider board, the PLC, believe that it gives us an excellent base to kick on through Q4 and into 2025, and continue in the transition and the journey that we've been on for the last year or so. Thank you very much.
That's great, John, Kevin. Thank you once again for updating investors. If I could please ask investors not to close this session, as we'll now automatically redirect you for the opportunity to provide your feedback in order that management can better understand your views and expectations. This only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of RBG Holdings PLC, we'd like to thank you for attending today's meeting. Good morning to you all.